So in this video, we are going to really dig deep into how commissions work on whole life insurance products. We're going to look at different life insurance companies, different products, and really if you have a goal of maximizing the cash value on a policy, I hope this video is helpful just to provide more information to find out if the policy is truly set up in your best interest, meaning maximum cash value and not maximum or a higher commission by sacrificing your cash value performance. So let's get into it. We're going to look at 3 companies in this example with a number of products. We're going to look at 2 of your 4 major mutual companies, being MassMutual and Guardian. And then we're going to look at a smaller company, which is popular in the high cash value space. A lot of times people, when they're considering a high cash value life insurance policy, are being shown options with this company as well. So to get on into it here, with MassMutual, they've got a number of products. These are the 3 primary products that most people we work with look at. There's also the 15 pay here, which is similar to the 10 pay product. We can pay into it for a maximum of 15 years, where the 10 pay is 10 years. What I'll add about the 10 pay and 15 pay policies is when you look at just pure cash accumulation, they have strong internal rates of return. They also have lower PUA fees than what other products with MassMutual have. So it is a nice option. The only thing that some people don't like is the fact that a 10 pay can only pay into it for 10 years. So if someone wants to pay longer, it does not always make sense. Let's begin with a Whole Life 100, which is a traditional whole life insurance policy. The 100 represents the age that you can pay into it. Literally, you can make premium payments until you're 100. Not too many people actually do that from what I've observed over the years, but you can continue to feed the policy if you'd like. So what we'll begin with is the first year commission, and the commission rates are based on the maximum rates that we receive from the insurance carriers. So when you're talking commissions with an agent or broker, if you're in the business, if you're new in the business, you're going to start at a very low commission rate as a broker. If you are experienced, you've done a lot of business, you have a proven track record, you may earn your way up to the maximum commission level. So why I state that is if you are asking for a commission disclosure, you might see the same product with different commission rates. I would always ask for the max rate. This way you've just got full transparency across the board. There's no low rates, middle rates, high rates. And what I'll add, one more thing that's important, is regardless of the broker you're working with, if you're working with a broker who's paid a minimum commission rate or a max commission rate, and the policy is designed in an identical manner, the cash values for you will look identical. There won't be any difference in performance. The only difference is from the insurance company's perspective. If you've brought insurance company A a ton of business and I haven't brought them anything, they're going to pay you more for the same business because they value your business. You've already proven yourself and they want you to continue to bring them business. So that's the difference in rates there. You can kind of just earn your way up to a higher tier, to explain it that way. So these are high tiers. MassMutual can be a little bit higher, just from what I've seen before, but we're at about a 93.5% rate on base premium dollars. So assuming we've got a $10,000 base premium, 93.5%, $9,350 on the base premium piece. PUA rider, assume the same $10,000. The commission with MassMutual is 2% on PUA riders, giving me a total commission of $9,550 in the first year. So that's the first year alone. And then assuming that payments are made the same $20,000 total, the 10K base premium, and the $10,000 PUA, then the 10-year total commission over 10 years combined is $15,850. So call that the lifetime value of that policy sale, what I've earned cumulative over a 10-year period. And this would assume a design with PUA riders and a 1-year term rider. I want to add something here. So I've got 2 different types of term riders. I've got a 1-year term rider. This is sometimes referred to as a blended PUA. With MassMutual, it is their LISR rider. And then I've got a level term rider. With MassMutual, this is referred to as a renewable term rider, which has a level death benefit, a level premium for the first 10 years. And if I keep it on longer than 10 years, then the cost begins to go up. But what I want to add here is because this video is on commissions. This will pay a higher commission. I didn't include this in here. It's usually 40% in the first year, 30 to 40%, whereas this term rider does not. This pays the same 2% PUA commission rate. So 1-year term riders pay the same the PUA rate, in this case with MassMutual, whereas level term riders do not. So that's with the Whole Life 100 product. Let's look at the high yearly cash value policy. And we're going to look at a year-over-year breakdown too, as we've got all of this built in a program. So I'll show you exactly how it works. With a high yearly cash value product, same thing. $10,000 base premium. In the first year, you do not make that $93.50. The earnings is $1,870. So $1,870 on premium dollars. That's 18.7% in the first year. PUA commissions are exactly the same 2%. So in the first year, I've made significantly less, a little over $2,000 total. Whereas with that Whole Life 100 product, I've earned $95.50. However, over the period of 10 years, what's the total commission? $16,850, whereas the Whole Life 100 is $15,850. So I actually earn $1,000 more. It's not a huge difference over 10 years when you think about it. It comes out to $100 per year in this example, but I do earn more with this product. The compensation is just spread out over the life of the policy, or I should say over 10 years. And the reason why is because how this product is different. A Whole Life 100 product, with respect to your cash value, gives you 0 in the first year, whereas this guy gives you 80% in the first year. So you've got more cash value up front. That's the big difference there. Looking at some Guardian examples. So Guardian has a number of products that we'll often consider. We've got their L99, L95, and then L121. A lot of times people will look at this L95. I've got that product. I also have a 10 pay with them. We look at their 15 pay a lot. Executive Strategies, whole life products. These are great for executive benefit planning cases, premium finance, and higher net worth individuals. It does have a minimum base premium requirement of $100K. For a single individual. If it's a company, the base premium requirement's a little bit less if it's on a number of individuals. But my point is, it does have a higher base premium requirement at $100K for a single individual than any other product they have. And then we've got riders, the PUA rider and 1-year term rider, and then a level term rider they have, which is also a renewable term rider, but that begins renewing year 2. As far as the premium gradually getting higher. It's inexpensive though. Their 1-year term rider, how that actually works is in the first year, whatever the cost of that 1-year term rider is, they pay the same commission rate as the base premium. And then from the second year onward, they pay the same rate as the PUA commission. Which that's usually a very, very small number, but for the sake of transparency, I wanted to add that point. So L95, $10,000 base premium. Here's the max commission rate, $8,500. PUA, 3.25%, $325. Total first year commission, $88.25. Commission over 10 years, about the same as the two above, $16,550. Not much of a difference there, really, when I compare those two major mutual companies. We can look at different products with different rates. You will see a little bit less total with a 15 and 10 pay product with a Guardian compared to other options. We've got the grids, which I can walk you through. But my point is, similar here from a compensation standpoint. And going back to the message I'll always talk about, how do you maximize your cash value? Policy design 1. And then who have we seen proof of performance with? Which I'm so big on. 4 major mutuals, Mass and Guardian, and then also New York Life and Northwestern Mutual. We can't even use Northwestern Mutual as a broker. They're exclusive to their career agents. But why I mention them is frankly because they've delivered. Simple as that. A lot of times we work with people where we look at their policy, we recommend keep it in force, continue to max fund it, unless the design was just not attractive with a high base premium or something like that. There are occasions where we look at it and say, hey, this wasn't designed, we can do a lot better, and we'll examine the guaranteed and non-guaranteed values. My point is, proof of performance, going back to the last video. I've seen that with the major mutuals. Then we've got these guys. Lafayette, two of their products here that are most commonly used. They're Contender Life and then they're Patriot Life. And riders that are used, they've got 3 different PUA riders. They do not offer a 1-year term rider. They offer a level term rider that ranges from 7 to 30 years. And what it is a level death benefit along with a level premium. And that term rider, the actual commission rate, which we don't have here in the first year, can range between 40 and 60% in the first year, if it's 10 years or more. So at their highest rate, they'll pay 136% commission on base premium. So if you've got that same $10,000 base premium, that would give you $13,600 in compensation. PUA riders, the rate will vary. If you're closer to the higher rate, it'll be about 5%, although it can get higher than that. So it's about $500. So look at this. In the first year, you make $14,100 with the designs being equal with these 3 companies. That's almost what you've made over 10 years with those other major mutual companies. And then the 10-year total, you make $28,600, close to twice as much as the other carriers. So that is significantly more when we look at the compensation. Now, is that a bad thing? Does that mean an agent is a bad person if they're showing you this company? No, not at all. I will add this, as of the date of shooting this video, we don't use them. We have not written any policies, and the only reason why is we have not received any proof of performance from them. Actual policies that have delivered strong internal rates of return or even one of a 4% IRR or greater, going back to where buyer's remorse often pops up. But let's take a look at some grids here. So what we do is pull all the commission grids from the insurance carriers, and then we just plug everything in here for total transparency. So if we're going to look at the products we just examined, let's begin with MassMutual. And what do we see here? So if we're going to look at this, we've got the first 10 years, total payment, $20,000 per year. There's my base premium, everything we just saw on the whiteboard. First year, $10K base premium generates a base premium commission of $93.50, PUA commission at 2%, $200. There's my total $95.50. Then I've got the renewal commissions with a traditional whole life 100 product. What do I see here? 5% per year is what it comes out to, which is $500 of the 10 grand. Total commissions, there's the $15,850. I've got my high early cash value, which pays an enhanced rate with overrides for the first 5 years, not just year 1. And the fun part about this, let's take a whole life 100 here. And this is actually based on, this is a 10/90 split, meaning we've got a 10% base premium, no renewable term rider because we've got a blended PUA, and the individual is funding it for 30 years in this case. And here's my cash value and death benefit. But what we do from a commission disclosure standpoint is disclose the rate. So what we would do here, so this is already plugged in, but you'll see everything match up here. Let me do this. 10K base premium, total of 100. First year commission, $11,150. Going back to this, so we've got the total of 100K going in, 10K base, $90,000 PUA, first year commission, $11,150. By year 10, $31,850, same thing here. So at 100K per year going in. Now what happens if I alter that design and go with a 30/70? We would plug in the actual values too, so we can see the cash value performance and measure that. That always comes first. But if you want to know what the compensation is, like when I raise that base premium, which is going to reduce the performance of cash value, it's going to increase the compensation, especially in the first year. So there's MassMutual. We made that the 1090 in that example. And we can do the same thing with the other examples. There's Guardian. Let's take Lafayette as well and just look at them side by side. And in fact, let's do this for the sake of capturing everything here. Much better. All right, so what do we got here? Different rates side by side. If I make them all the clean $20,000 per year again, the 10K base, $10,000 PUA, we can see everything side by side. And then we've got that with all the different products and such, just for full transparency. Some people we work with don't care. Their main question is my policy set up for maximum cash value? Good, then I'm happy. Some do want to know, and it could be a trust reason, could be other things, but the simple way to put it is the policy set up for maximum cash value? And typically what you will find, the higher the cash value, the lower the agent commission. And if you think about it logically too, like if you're the insurance company, what's going to happen? I mean, what are you going to do? You can apply funds toward the cash value of a life insurance policy, or if they're not going toward that, if they're going toward the base premium and death benefit, you do not have to give that money in cash value in the first year to a consumer, so you can pay more to the agent. Simple as that. So I hope this video was helpful with respect to commissions. In the next video, we will look at a specific example, looking at a split study with these different carriers. But I hope you enjoyed this one. Thank you so much. And as always, again, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.